Welcome to Finance in 5. Greetings friend, welcome back to the channel. So last time we talked we were looking at mining stocks. If you haven't checked that out, be sure to watch it as it goes over a lot of useful content that's relevant to today's discussion. We're just going to get straight back into it. We were talking about ETFs, or exchange traded funds, which invest in 10 or more precious metals mining companies of small or medium-sized market capitalization and tend to move in the same direction as the underlying precious metal itself. The story is similar for silver ETFs with respect to silver as it is for gold ETFs with respect to gold. Take a look at this chart for a well-known silver ETF. You can see its performance has outpaced that of the white metal during the bull run which took place in 2020 between the March low and the August high. But one thing to watch out for is that when silver's price drops, this ETF also drops roughly twice as much. But in view of the fact that the current sale price of silver is fairly low, you could argue that silver miners offer a competitive entry point right now for participants new to this market. And even though past performance is no guarantee of future success, now that metals are pulling back a little bit and are in this consolidation phase as people rotate out of metals and miners into other sectors, this might not be a bad time to buy. As Buffett once said, be greedy when others are fearful. I believe that the biggest gains will be observed in the future. In fact, for more on that, you should definitely check out my presentation called The Path to $100 Silver, which lays this thesis out in more detail. But rather than being gold itself, or even gold ETFs that have produced the most returns, the class of companies which have performed better even than these are called royalty or streaming companies. One such example is Sandstorm Gold. Sandstorm Gold was a huge winner with nearly 700% gains between the years of 2009 to 2013, as well as larger streaming or royalty peers or contemporary companies which included Franco-Nevada and Royal Gold, because several of these companies saw their stock prices increase by 20 times or more in just 2 or 3 years' time. While rising gold prices contributed to these gains, these companies also greatly outperformed the typical mining companies as they created more value with less dilution to shareholders. But separately from this ETF, let's mention one or two other companies that might be worth a look. There is a company called Ely Gold Royalties, which Eric Sprott bought 9.375 million shares in at 80 cents per share in May 2020. This is a Nevada-focused gold royalty company. Its current portfolio includes royalties at Jerritt Canyon, Gold Strike, and Marigold, which are 3 of Nevada's largest gold mines, as well as the Fenelon mine in Quebec. The company continues to actively seek opportunities to purchase producing or near-term producing royalties. Ely generates royalties through land staking and acquisitions. They will develop a project and then sell it to a third-party mining company on a 100% basis, typically under a 4-year option agreement. After payments are completed and the property sells, Ely will retain a royalty interest. However, if the miner cannot make payments, Ely would get the property back. So they generate or guarantee cash flow for themselves one way or another, without having to eat the cost of extracting the mining assets out of the ground themselves, which instead gets done by a third party. Ely has been able to build a respectable royalty portfolio in a very short period of time, and as Ely states on its website, the majority of the properties are located in some of the most prolific and desirable gold trends in Nevada, which include the Walker Lane district of western Nevada and the Cortez Trend. Ely Gold also generates development royalties through property sales on projects that are located at or near producing mines. Management believes that due to the company's ability to locate and purchase third-party royalties, its strategy of organically creating royalties and its gold focus, Ely Gold offers shareholders a favorable leverage to gold prices and low-cost access to long-term gold royalties within safe mining jurisdictions. In my view, the significance of the Sprott investment shouldn't be underestimated. If you look at Warren Buffett, in 2020 he has also invested in Barrick Gold and sold it later on for profit. Why are these top investors buying mining companies in preference to outright ownership of the metal? Well, the increase in interest, in my view, reflects an obvious increased upside potential. Anglo Gold Ashanti has been in steady decline since July's $38 a share peak, down almost 45% in total after this week's price dump in gold and silver. I believe the sell-off is getting a little overdone for one of the largest gold, silver and copper miners in the world. For new investment capital, you can now buy Anglo Gold at the lowest forward projected price to earnings valuation. On the upside, the company is generating record free cash flow today, has repaid all of its debt, and still has reserves likely in the 10 to 15 year range at current global metals pricing. If you're building out a precious metals portfolio, like many people new to these ideas might be doing, Anglo Gold perhaps deserves your consideration. The company just exited its South African mining assets, which had been its mainstay of revenue and cash flow generation for decades. The South African mines were sold to Harmony in September for $300 million, which represented 12% of trailing 12-month company production, and some of its highest all-in cost operations. The remaining mine life is estimated to be between 2 years to 15 years based on proven reserves. The good news is that each asset has the ability and potential to pull new revenue and production out of the ground with higher gold prices, well above the conservative $1,100 an ounce long-term selling price assumptions which were made in 2019. So if history is any indicator, and many of us believe it to be a very strong one, particularly in this case, intermediate and longer term gold pricing only has one way to go, and that is much higher from here. So a move to $2,500 per ounce would be an increase of roughly 32% from current levels, and a surge to what many people project to be the year end of 22's target of $3,500 per ounce would be a move of roughly 85% from current levels. Investment in gold ETFs would add significant upside leverage even to these investments. Warren Buffett sold his banking shares and first moved to gold shares. Berkshire Hathaway bought a stake in Barrick Gold in the second quarter of 2020. The total stake in Barrick Gold was worth about $564 million. Then Buffett sold 9 million shares of ABX, trimming the position 44% from Q2. He also sold off his Wells Fargo, JP Morgan Chase, PNC Financial Services, and M&T Bank shares, according to reporting by Yahoo Finance. Importantly, he's been liquidating his bank stocks. Why is that so crucial? It seems to be the case, according to many, that big tech is moving in to replace banks. And it should also be remembered that this particular gentleman, who I can't name because otherwise YouTube instantaneously bans everything I say, has also removed himself from the board of Berkshire Hathaway in order to attempt to hide his influence over the various investment decisions of Buffett. And it's also evidence that that particular gentleman who created that particular software empire has been looking to help certain countries to eliminate paper currency and move digitally. And there's evidence of that in countries as far away as India. So anyway, moving back to our conclusion about gold, there seems to be the case that everybody's looking for value, but trend-wise, we're looking at the short rather than the long term. Gold and gold miners and gold mining streaming royalty companies generally appear to be in suspended animation, where market participants are too focused on short-term news instead of looking at the big picture. The big picture is pretty simple. It involves a lot more money printing, Federal Reserve balance sheet expansion, an exploding national debt, a perpetually exploding monetary base, the economy slowing to a crawl under Biden's lockdowns and aggressive taxes, lower interest rates for longer, and much higher gold, as well as much higher gold mining prices going forward. It might not be immediate, but it's something that's going to unfold over the course of the next few months and possibly year and a half. Anyway, thank you very much for watching, and be sure to check out my recent video. I just put it up about how silver is likely to experience a massive upside spike in its value during the month of December. You're not going to want to miss it. All the very best.